If you're selling naked calls and thinking it's just collecting premium, you're on the battlefield without body armor. Welcome back to Retail Recon. On today's mission, we are going to debrief short vertical call spreads, also known as the bear call spread. This is one of the most foundational defined risk strategies in options trading, and it's perfect for beginners who want to sell premium without opening themselves to unlimited risk. By the end of this episode, you'll understand what a short vertical call spread really is, why it behaves the way it does, exactly how to build one, when to deploy it, what are the common mistakes and how to avoid them. Let's dive in. A spread is a multi-leg option strategy where you deploy two or more options working together towards your goal. Generally, anytime you see short or bear in the name, it will imply opening the position for a net credit and long or bull for a net debit. The whole ratio behind any type of spread is deploying your trade idea with predefined risk. But because every action has an opposite reaction, you are capping your profits as well. In options terms, a vertical spread means two options of the same type, both calls or both puts, same underlying stock, same expiration date with different strike prices. A bear call spread, short vertical call spread, consists of selling one call closer to the current stock price, the short call, buying one call at a higher price, long call, both options with the same expiration date, and you collect a net credit from setting up the trade. The ratio behind is you're not selling a naked call. You're defining your risk with the higher strike the call you buy. In this setup, you're selling premium with installed safety net. When the strategy fits, a short vertical call spread is best used when the stock is not expected to rise sharply in the near term. Implied volatility is relatively high, so credit is attractive. You want to sell the premium but don't want naked call risk, and you're comfortable with a defined loss if the stock does surge. Typical battlefield conditions: range-bound stocks that keep bouncing between support and resistance. Stocks that just had a big run and you believe further upside is limited. Elevated IV environments where options are expensive and premium collection is juicy. Moving on. One of the attractive things about short vertical call spreads is that time decay works for you, just like with covered calls. If the stock stays below your short strike, the entire spread slowly loses value as time runs out. You want the price to stay at or below your short call, that is the one you sold. As expiration approaches, the spread moves towards zero and you keep the full credit as profit. That's the ideal scenario. The spread expires completely out of the money and you walk away with the max profit. Remember the lesson from the previous episode? Always look at the options from the perspective of a buyer. If the short call is below the strike, it is worthless for a buyer as he can buy cheaper at the market than at the strike. And of course, with a long call, you are the buyer and you are in that position. This is not a wild directional bet. It's tactical positioning. You're mildly bearish to neutral. You expect the stock not to move aggressively higher. You're using volatility and time as your allies. It is critical to understand the trade-off mentioned in the beginning. By defining your downside, meaning your max loss is limited and known where you enter the trade, you are capping your upside. That is the max profit you can squeeze out of this trade. In numbers terms, your max profit is limited to the initial credit you received when you opened the trade. Your maximum potential loss is defined with the spread width, that is the difference between the short and long strikes minus the credit received. So in this setup, you're never going to go for a home run on a single trade, but you're also not going to blow up if you size it correctly. Practical rules of thumb: never risk more than 1 to 2% of your account on a single vertical spread. Prefer wider spreads only if the probability of profit is high and the credit is meaningful. Always calculate break-even up front. That is your short strike plus credit received. A word about managing the trade: simply don't overmanage because you're scared of losing the max. A short vertical call spread is defined risk by design. That means you know your worst case scenario at entry, and using defensive tactics should be limited because the loss is already capped. You know where you will end if everything goes against you. In practice, this usually means let it run if the stock stays below your short strike and you're comfortable with the risk. Close early for a small loss only if the stock is spiking hard toward your spread and you see a higher probability setup elsewhere. Do not treat verticals like stocks and average down or double up when you're losing. You already defined your loss. Don't redefine it. Side note about legging into the trade. Those are the situations where you first open one position, for example, short call in a covered call setup, and then add another leg, let's say long call on top of your short call, effectively turning it into a bear call spread. Generally, you would want to avoid those types of trades, as it is better to submit the whole setup to your broker with defined credit upfront, as both trades will be executed in coordination. Same goes for closing them. But there is also a case for legging in as well. From my experience, the best case is when you want to stop the bleeding when the trade goes hard against you. In those cases, it might be cheaper to buy a call, add a wing to your trade, than closing or rolling your call. Back to the bear call spread. We are going to put everything you learn into perspective by going through a step-by-step example. Imagine ABC is currently trading at $4.23 per share and you have a bearish outlook because the stock just broke above key support. You expect ABC to reach $4.10 in the next 30 days but doubt it will break down below 400. Step 1. Select your strikes. You sell the 420 strike call option expiring 30 days out for 15 premium, that is 1,500 total since each contract controls 100 shares, and simultaneously you buy the 430 strike call option, same expiration for 10 premium, that is 1,000 in debit. Step 2. Calculate net credit. 1,500 credit minus 1,000 debit equals 500 net premium you receive when you enter the trade. This 500 is your maximum possible profit if ABC stays below 420 at expiration. Step 3. Determine max loss. Strike difference, in this case 430 minus 420 equals 10 times 100, that is 1,000 potential, minus 500 net credit equals your 500 maximum potential loss. Break-even calculation, short strike plus net credit. In this case, 420 plus 5 equals 425. ABC must stay below $425 just to get your money back. Let's now look at three scenarios at expiration. ABC at 430. Your short call is now worth $1,000 to the buyer, meaning you are at $1,000 loss as a seller and your long call is worthless. But since you received $500 in net premium, your overall loss is $500. You are at maximum loss. If the stock went higher, same scenario, just in that case your long call would start gaining value and would offset the rising loss in the short call. Now you see why your loss can never go above 500 in this example. ABC at 425. 420 short call is now worth $5 or 500. 430 is worthless, but since you received 500 in net premium when you opened the trade, you're at break even. ABC below 420, you are at max profit. Let's use 415 for calculation. Your 420 call is now worthless to the buyer and your 430 call is worthless to you. Any way you play it, you get to keep the full net credit received and that is your maximum profit possible in this trade. Key points to remember: max profit is the credit you collect if the stock stays below the short strike at expiration. Max loss is the spread of the strikes minus the credit received. Everything in between creates a partial profit or partial loss depending on where the stock lands. Let's now go through some common mistakes and misconceptions. Mistake 1. It's just a call. I'm fine. Don't treat a short vertical call spread like a single call cell and ignoring the structure. You need to respect the width between the strikes and calculate the exact max loss. If you don't size it correctly, even a defined risk can still hurt your account. Always calculate your exact max loss and break even and check them against your rules of engagement to ensure they fit your rules about position sizing. Rule of thumb: don't go above 1 to 2% potential loss per position. Mistake 2. I'll just roll it and save it. Seeing a losing vertical and trying to roll it like a covered call. Why it's bad? Unlike covered calls, verticals are symmetrically defined. Rolling them often just extends the risk without real improvement, especially if you're still in the same strike window. Don't turn one bad trade into two. Treat a vertical like artillery fire. Engage, observe, accept the outcome. If the trade is going wrong, close the spread or let it expire instead of clutching new strikes on top. Mistake 3. High IV means I can sell anything. Seeing elevated implied volatility and selling verticals on every stock without thinking about directional bias or technical structure. Why it's bad? Volatility can be high and the stock can still run through your spread. You're not getting paid for volatility alone, you're getting paid for time and range. Only deploy short vertical call spreads when you also have a clear thesis that the stock won't spike about your short strike. Treat high IV as a bonus condition, not a blanket license to sell. Mistake 4. I don't need to understand deltas or probabilities. Entering the trade without checking delta or probability of expiring out of the money on the short call. Why it's bad? You might be trading 50% probability play thinking it's a safe 70 to 80% setup. Prefer short calls with delta around 0.2 to 0.3 as a starting reference point. That's roughly 70 to 80% probability of expiring out of the money. Don't obsess over the exact number, but use it as a sanity check against your thesis. Let's recap this episode. A short vertical call spread is a twin call structure. You sell a call closer to the stock price and buy a higher strike call in the same expiration, collecting a net credit and defining your maximum loss. It lets you sell premium with capped risk, so you're not trading naked. It's a bearish to neutral tool, ideal when you expect the stock to stay below a certain level. Your max profit is the credit received if the stock stays below your short strike. Max loss is the spread width minus credit received. Your break-even is the short strike plus credit. When to use it? When the stock is not expected to run hard higher, volatility is elevated and you want defined risk premium collection. Key takeaway: short vertical call spreads are not a silver bullet but a disciplined defined risk weapon. If you respect the structure, size it right, and align it with your thesis, you turn unpredictable premium selling into a repeatable tactical edge. And with that, we close this episode. If you found value in this mission, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.